What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show, and today's episode is about bear markets bouncing, and we're going to map out some key levels to see if we're going to be getting a bear market bounce here in the very near future. As we all know, the market has been falling quite hard and fast. I haven't been able to report on the market because I went on a little camping trip, was petting a deer right here. There was no cell service, and this photo, it was leaked to my dog Coco. She got pretty upset about it, hit up her friends, and then brought down the market while I was away on a camping trip with the boys. Bam, bam, bam to the downside. We hit the lower expected move hard and fast right out of the gates on Monday. Talk about a lot of action on a Monday. And this is interesting, right? We took out the prior low. All right, we're now beneath the prior low over here. So the trend of lower highs and lower lows continue. And, you know, if you've been watching my episodes, we've called out the seasonality chart here. Looking back 20 years, it's the S&P 500 seasonality. We talked about the possibility of June getting undercut. That wasn't my forecast, but hey, it is matching that script. And typically at the end of June, you get maybe a quarter end markup. And in July, you get a summer rally. August is rather flat. It's not till really the end of the year, October and on, where you start to get some stronger movement in the markets. Now, everything is plastered over the news. The bear market's finally here. We've been talking about this, right? They're just now basically saying that the bear market's here. So we always got to be on our guards for when the potential market can turn back around. Now, there's a lot of bearish things taking place in the market. We have quantitative tightening taking place. Tomorrow we have the Fed meeting, and they were really looking between 50 basis points, right? That's what they've been saying, 75 basis points, and then 100 basis points, okay? And you can see here, the market's pricing in pretty much with almost 100% certainty of a 75 basis point hike. So, you know, I guess how can you interpret this? Is the Fed going to continue to do what it said it was going to do and do the 50 basis point hikes? And is the market going to take that as good news? Or are they going to look at that and say, well, they must not be taking inflation that seriously because we just came in at 8.6. Or are they going to do what the market expects, 0.75, and then it could be just kind of, market might not respond too poorly to that. Or are they going to come out of the blue and say, hey, we need to hit this hard and do a 100 basis point hike? Here's kind of my thought process on it. I'm just going to let the market digest and see what it really wants to do. But in the meantime, there are some trade setups taking place and some divergences that we're going to go over. Now, volatility is very serious right now. And let me point out what I mean, okay? This is the S&P 500. We just talked about it. Undercut the prior low, and we're at that lower expected move for the week, right? Those are those expected moves. Well, going into tomorrow's expected move, guess what? It's almost an $8 move on the S&P 500 using the SPY as the proxy. So that would put us right back up to this prior high right here, or potentially taking us under 370 come tomorrow. Now, typically 68% of the time, you close within the expected move for the week. However, right, and it's been consistent up until just this prior week, we closed outside of it by a whole, it was a 2 sigma move or 2 deviations out. So once that kind of inconsistent behavior takes place, it could become more inconsistent, where consistency kind of leads to more consistency. So what we're seeing right now is we're currently outside of that expected move for the week. We'll see here if it could come back in within it. Now, what's even crazier beyond that is that this is the options expiration, right, for the weekly. So this is Friday. It is a $13.28 move. That's what it was pretty much at the beginning of the week. So we're already 2 trading days in, and it's saying, hey, we can see just as much as volatility as we've recently seen, but up until Friday too. So you be on guard here. That volatility could get very, 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 very intense. Now, if we take a look at the 15-minute time frame, you can screenshot this if you want to map out those levels specifically, but there are some things taking place that I want to call out. We have a positive divergence on the RSI on the 15-minute time frame, positive divergence on the PMO, and we are wedging here. You can see contraction leads to expansion, and then expansion leads to contraction. So we're contracting once again. So that's probably going to lead to some sort of expansionary type move. Now, if we do close in the risk range, understand these sometimes can act like magnets. We might pop up, come back in, and doodle around, right? Tomorrow is going to be a volatile day, given that, one, we have the Fed meeting, right? The Fed announcement. And then also, on top of all of that, we have VIX expiration coming up. We have triple witching coming up. We got all kinds of things this week. So when I take a look at this price action chart, We're well below the 5-day moving average. That can hold as a level of resistance. So if you are more of a bull and you want to see, things get a little bit better before just hopping in, you want to see price action get back above the 5-day moving average. You want to see it start to flatten out and then start to head back up again, because as it stands right now, we called out when it was going neutral and then it became bearish, and we haven't actually tagged it at this particular point in time, which we will be tagging it at some point. Let's go ahead and take a look at the Qs. Qs, very similar situation. I went ahead and, let me back that out. Okay, yeah, I went ahead and screenshot this. I'm not going to go into the daily time frame for the Qs, but you can see right here, this expected move is just for tomorrow, which is a big move. And then the same thing that I talked about with the S&P 500, you see that there with the Qs. So we're talking still a lot of room for a lot of movement. Now we're right there at the lower range, positive divergence, and we also have that falling wedge. So a pop up higher. It's setting up for that, but just understand the context is bearish, all right, on these shorter time frames and even the longer time frames. If you take a look at semiconductors, right, that's a big portion of the Nasdaq composite, also very similar type price action, right? We kind of just traded sideways. We were wedging positive divergences. A pop higher is definitely plausible, but it just depends on really how the market's going to be digesting this news coming out from the Federal Reserve. Now, if we take a look at the IWM, similar situation. Here are the expected moves for tomorrow and then the remainder of the week. So once again, we've already had 2 trading days in the week, and it's saying that, hey, the expected move it's about the same size, but we've already taken a big hit to the downside. So we can definitely expect some more volatility. Positive divergence, falling wedge outside of the weekly expected move. So a potential move back up into it is more than possible. Heading into the remainder of the week. Now, this is where it gets a little bit interesting. Let's take a look at the volatility products, right? So VIX, it is clear above 30 at this particular point in time. We do have a little bit of a negative divergence, which says that, hey, we can come back down, maybe fill this gap, back test this level. Okay, but also you can potentially look at this as a flag where it can shoot off, right? We've shot off, but yet we haven't even got above 40, and the market's, seems to be freaking out here. So we'll continue to watch that. Not only the VIX, though, but Nasdaq volatility, it tagged into the 40s today, and where did it close at? Yeah, 38.51. So, this is not the area to play games and do wild, crazy things when Nasdaq volatility is that high. And then the Russell volatility too as well, clearly above 35. It closed at 37.03. So this is where things can get very, very choppy. Now, as we've already stated, we have option expiration, VIX expiration. We had the Fed meeting. Everything kind of it seems to be setting up for some sort of a gamma squeeze, especially looking at these expected moves. And by gamma squeeze, what I mean is it can be squeezed to the upside, but it can also be squeezed even more to the downside as well. So be very, very, very mindful of that going into the remainder of this week. If we take a look at oil, oil had a pretty interesting day today. It was down 1.65%, but this candle on the daily, it actually, it got above all the prior, 4 or 5 trading days, and it got below them too. So this outside trading candle, as it tagged kind of this prior area of resistance, didn't quite reach up there. Wanted to call out that the PPO is just about to do a bearish crossover. So, hey, maybe this is going to take a little bit of a breather here soon. That's a strong possibility. But the context of this, it's still bullish. So just be mindful that it is bullish at this particular time, as well as obviously the dollar. The dollar continues to be bullish. We broke out. We've ripped higher up into this upper Bollinger Band, and that strong move, you can just see it hurt equities big time. And we'll see here if the dollar is going to be taking some sort of a back seat here momentarily. And if it does start, taking a little bit of a breather, the S&P 500 could take a little bit of a breather. It could maybe float up a little bit, potentially form, another retracement, which would be just another bear flag. And that's what we've been seeing, right? You see a strong move down, pulls up, right? Bear flag, strong move up, bear flag, right? And then we've ripped up. That was a big one. And you can see here, we're just putting in those lower highs, lower lows. And then we're kind of just in this downwards channel at this particular point in time. Okay, another thing to watch is obviously the yields. Yields have been just blowing through the roof, which is definitely hurting the equity market too as well. The 2-year had just a gigantic run. The 2-year is at 3.45, and you can see here the 30-year is at 3.45. So we're talking inversions there. It's not too far off from the 10-year, which is 3.49, but we're getting some more inversions taking place. Even the 10 and 2, the 10 and 2 is at 0.04, which is darn near right back close to an inversion, which could be signaling, hey, we could be getting that recession, right? We already had that back here, but you can just tell that these do look like they're going to be moving more further into inversion. The 3-month, look at that, it's at 1.83, a huge move after that CPI report. And this is the 10-year 3-month, which is an important one to watch. That's still well off inversion, but it has been just kind of pointing straight down, which tells me, hey, if we start getting this one, which is even, that'd be more important to watch for an inversion. It potentially is not too far off in our distant future. Now let's talk about some actually bullish things that are taking place, right? We had some price action, bullish developments, kind of, right? We had those positive divergences, and we also had these kind of falling wedge structure, right? Contracting. Well, here's another one. This is HYG, okay? Looking at the top, and then we have SPY at the bottom. So what we called out was, we called this out here, and we said, hey, perhaps, this positive divergence here where HYG was putting in a higher low, right? And then the SPY was putting in a lower low. That might mark some sort of a pop to the upside. And sure enough, we started ripping up higher, right? That was the start of that bear market rally. And then more recently, we talked about, HYG is actually putting in a lower high and the SPY made a higher high. That right there is a negative divergence. And perhaps now we might see the market start to roll over, just to be cautious of that. Sure enough, HYG started rolling down. SPY started kind of just going sideways along with the other index products, and then bam, when we hit to the downside, it was a whirlwind down. But what I want to call out here is today, interestingly enough, right, this is going into the Fed meeting, so this could be easily skewed around, but the SPY put in a lower low, and HYG did not. You can see right here. So you can see the 13th, we had, a low here, and it started dragging down. Well, the 13th, we had a low, and we haven't cracked down through that low yet with HYG. So it could be signaling potentially, right? And these things move hand in hand. If HYG starts to take off here, the SPY could very well follow, and this could be an early indication of that. All right, so nothing's certain, but it's something to be aware of. And why, how can you take this information? If you don't want to go long right here, how can you take this information? Well, maybe you're bearish. Well, this probably isn't the greatest area to just be a bear in when the market has taken a big, huge hit to the downside already, right? You want to short when we were talking about it up into this range, and then you want to cover when you get these huge gains. All right, so now what we got to do is, if you are bearish and you want to follow the trend, we got to wait for some sort of a rally, some sort of a pop, or you start, if you're really tactical, start looking for long positions. Can this go down, straight down, further and further? Yes, absolutely, but you got to look at things based off of risk reward. So if you were to enter short right here, okay, where would your stop loss be? Would it be right above here, or would it be above this right over here? It just depends on your time frame. It depends on a lot of different factors. Not to say that you would be wrong there, but just that's just kind of my thought process behind that. Now, some more things I don't call out is the NDX, and we're going to look at the percentage of stocks above the 50-day and 200-day, and you can see we are getting into some tragically low areas here. So stocks are getting beaten down when we've reached these low levels prior. As you can see, this little green line across the screen, they actually marked bottoms in various charts. Not all of them. You can see right here. I mean, it was, if you zoom in, you'll probably catch the little tiny bottoms, but it was in a bearish trend. And then over here too, bam, and then right here, bam, too as well. So this is something interesting to watch for, because this is where bear markets can potentially rally. So be aware of that. If you look at the same thing with the S&P 500, percent of stocks above the 50-day up top, 200-day at the bottom. Look at this reading right here. It's at 4.81. If you just look back, right, that happened in the pandemic crash. It happened right here in the Christmas Eve nightmare or massacre. We got right here. So you can see the S&P 500. It's a little bit more accurate at hitting those, but you can see this is a very, very low reading, which could indicate some stocks are very overextended and they may see some sort of a bounce. That doesn't mean it marks a bottom, but it does potentially signal that, hey, this is just another reason why not to potentially short right into this area, and maybe potentially look for a long position. Maybe if you're a very long-term investor, this could be an opportunity to just, if you're in the next 20, 30 years in the market, be like, okay, now cool, I can add a little bit more here. And if it even drops even further down, which is a very strong possibility over the course of time, given what's going on with the Federal Reserve right now, you can do more and you can dollar cost and do whatever your strategy entails. I'm more of a tactical, shorter-term trader myself. If we take a look at BP NDX chart, we talked about when they were getting overbought, right? Coming into the overbought territory, well, it just took a couple of days and now we're almost down to overextended to the downside territory. So not quite there, which signals that there could be some more room to fall, but just be mindful that we're not too far off from being overextended to the downside. BPSPX chart is darn near overextended to the downside. It's getting to that oversold territory, 30.97 if it gets below 30. So it signals to me that there's some more room to fall. If you take a look at just where the reading is, it's at 21.40. that basically means 21.4% of the stocks in the S&P 500 are on buy signals. So just getting completely just withered away. If we take a look at the NYMO, the Nasdaq McClellan Oscillator, another indicator right here. It is moving into that minus 80 territory on the daily, which signals a pretty big overextended. And you can see when it reaches these levels, bam, 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 right? They mark some rip and rallies. And this is a very strong move to the downside. Are we going to get some sort of squeeze back up? We're going to look for some more new shorts. Is it going to continue that lower high trend? And then all is well in this trend. We will see. I will note that surprisingly there is a very subtle divergence taking place, right? If you pay very close attention, we hit a new low today on the New York Stock Exchange, but you can see that the NYMO actually upticked slightly here. So lower low, higher low, which is a very, very subtle positive divergence that not too many people pick up on, which tells me, hey, this move lower could be potentially getting weaker. Potentially, right? It's all potentially, and you can see that it's also in an overextended territory, which could signal potential bounce in the near future. Now, last chart that I want to really talk about, and I'll get into crypto tomorrow. I didn't want to kind of make this video too long, which crypto just, wow, holy moly, right? We talked about this negative divergence and it did play out to the downside, right? So it resolved to the downside. It ended up being a negative divergence. I want to just call out here the summation index. We had the parabolic SAR uptick, so that now could potentially signal a trend change here in the New York Stock Exchange, and we can see that there's already been a dramatic move down. So even a pop up higher, it might not take that parabolic SAR up, which could just continue this kind of trend back down. So that is something that we want to be well aware of. And you can see here on the 9-Mot, which is very similar to the McClellan Oscillator right over here. You can see we're getting these low readings, but this is a traditional calculation. You can see it's at minus 250 here, which it doesn't necessarily mean it's overextended to the downside, but we've seen bounces at these low readings before. So going into tomorrow's meeting, just be very mindful of the volatility that's kind of set going into the Fed meeting and also the OPEX. That's all I got really for you on today's episode. Pay attention to these expected moves for the week and also going into tomorrow. And just best of luck out there, right? Just be careful, manage your risk very tightly, and let the market digest and do what it has to do, and then strike when the right time comes. That's all I got for you. See you later.